The stock market is near all-time highs. So should you wait to invest, or is now the right time to get your money working? I'm Kerry Green, financial advisor and co-founder of Green Era Financial, and I help people near or in retirement to get the most out of life with their money. Today we're tackling a question I hear a lot, especially when the market is setting new records. Is now really the best time to invest? So let's walk through what the data shows, the emotional traps to watch out for, and how to think about investing when things feel like they're at the top. It's totally normal to feel nervous about investing at all-time highs. After all, the saying goes, what goes up must come down. But that fear is often based on the idea that a drop is coming immediately. In reality, markets often hit multiple all-time highs in a row. In fact, they spend more time near all-time highs than you might think. For example, from 2013 to 2021, the S&P 500 hit over 300 new highs, and yet investors who waited for a dip often ended up sitting on the sidelines for months or years, missing out on growth while they waited for the right time. Additionally, if you're not invested on the big days when the market is up, you actually miss out on a lot of the gains. For example, looking at the last 30 years, if you missed just 10 of the best days in the market, you may have erased your gains by 54%. Missing 20 days could have cost you 73% of your total gains, and missing 30 of the best days in the market over the last 30 years could have resulted in 83% less returns. Okay, let's talk about timing the market versus time in the market. Here's what the data shows. Trying to time the market is really hard. Even professionals struggle to do it consistently. But staying in the market and letting your money grow over time, that has a much stronger historical record. If you invested a lump sum at all-time highs and left it alone, you still did better than those who waited for a dip that never came. In fact, studies from firms like Vanguard show that over time, investing immediately, even at market highs, tends to outperform dollar cost averaging, or waiting for a dip or correction. So what actually happens after a new market high? Historically, the market tends to keep climbing. According to research from First Trust, 1 year after a record high, the S&P 500 has been higher about 70% of the time. 3 years later, that number goes up to over 80%. Of course, past performance doesn't guarantee future results, but it tells us that all-time highs don't automatically lead to crashes. Often, they just mean the market is doing what it is supposed to do, grow over time. Still nervous? That's okay. If investing a lump sum all at once feels uncomfortable, then consider dollar cost averaging. This means investing smaller amounts on a regular schedule, weekly, monthly, quarterly, regardless of what the market is doing. This helps you avoid the pressure of perfect timing, smooths out your entry points, and builds discipline. And remember, most people already use this strategy without thinking about it. Every 401k contribution is a form of dollar cost averaging. So the real question isn't, is the market high? It's, what's this money for and when will I need it? If you're investing for retirement in 5, 10, 20, or 30 years, the short-term market level matters a lot less than sticking to a long-term plan. Even if a dip comes next week, staying consistent and invested tends to beat trying to outsmart the market. All-time highs can feel scary, but they're often a sign of a healthy growing economy. Instead of trying to predict the next move, focus on what you can control, your goals, your time horizon, and your plan. If you need help creating an investment strategy that fits you, or if you just have any questions I can help you with, feel free to reach out to me. I'm always happy to help if I can. Thanks for watching. I'll see you next time.